All right. Well, thank you everyone who's joining us. This is the Exit Advisors weekly town hall series focused around small businesses. This is a really great topic we have today featuring Roger Ledbetter and Wesley Middleton. They're going to be diving into the CARES Act and the HEALS Act. But this isn't just going to be kind of a recap and the culmination of what has been, but really a little bit about what's to come as well. And as you can see, the formula for a business recovery. So before I pass it off, I'm going to give a little introduction for Exit Advisors. Many of you have heard this before, but Exit Advisors works with small businesses, the lower middle market size businesses, and entrepreneurs to help them prepare an exit strategy and really tailor build one around their needs, around their succession plans. But also we take it a step further than most banks in that we really try to work with these business owners and entrepreneurs months or years in advance, start working with them to help strategize and identify red flags within their businesses, with whether it's operational, legal, whatnot. We bring in the experts to really to get the most value out of your business before we take you to market. And we're a very collaborative team. We like to work with folks like Wesley and Roger, with other CPAs, with search funders to really build out an a fully encompassed team that has a comprehensive understanding of everything that we bring to the table. So without further ado, I'll go ahead and introduce Roger, who's going to kick things off further.
Well, actually, Roger, you're on mute still, so I'm going to jump in right here. If you were talking, I'm not sure. But
I was. Nope, you're good. Take it away, Wes. Give me the intro.
Yeah, so actually, I'm going to do the intro. Roger's the featured speaker, so I'm going to do the intro and hand it over to him. Just a little bit about us. We are a national firm. We founded Middleton Drain Zapata back in 2013, and we grew it from probably 18 people to about close to 100 next 4 or 5 years. And then 2 years ago in November, we merged our practice in with Baker Tilly, and just so that we could bring primarily more services and options to our existing client base. So we are today, Baker Tilly, we are the 10th largest firm in the nation, and coast to coast. Pretty much try to stay focused on larger markets like Houston and other large markets, to have offices and to serve people just like you. So try to stay engaged with our clients and really be focused on being great advisors, not just great accountants, but being great advisors. If you go ahead and go to that, there you go. So this is us. So just myself, I manage our Houston office. And so my day-to-day is focused on client service and growing this market and doing things like this. In this situation, Roger he's one of my tax partners, and he leads our real estate and construction group as an industry. But Roger's become quite the expert on everything, PPP, CARES Act, you name it. I just quit talking about it and I'll let this guy have it because he knows what's going on here. So I'm gonna do my best to answer questions in Q&A. If you have some, I'll do that. If not, if I don't answer your question, it's simply because it's something that needs to wait for Roger to catch up at the end, and we will catch all of those answers at the end if something goes unanswered. So with that, Roger, take it away.
Got me. Yep. Making sure I'm off mute. So as Wes mentioned, if you have questions, feel free to use the Q&A function. He'll either answer them on the fly or we should have time at the end to go through some of them as well. I skipped past the notice slide, but just, full caveat. This is a lot of these things we're going to talk about are very fluid. We will talk about some enacted laws, but then a portion of our conversation today will be on proposed legislation or perhaps even partially passed to maybe one house of Congress. So that being said, if you have specific questions, please reach out to us or your loan officer if it's a PPP loan. So just seek expertise if any of these things kind of pique your interest. So what I'll hope to do is kind of 3 main objectives in our presentation today. It's a good chunk of information to get through, but I'm gonna try and get through it to leave time for questions. And the 3 things I want to talk about are just some general updates for the PPP loan, and then number 2 would be the employee retention credit. These are the PPP loan and the ERC is what I'll call it. These are the 2 primary ways in current enacted legislation that is out there for small business and medium and large businesses to help with some of the recovery. So I think a lot of us have some fatigue on a lot of these topics. I'm not going to do an overly nerdy presentation on PPP. I think we're all there. But then the third option, or the third topic I'm going to run through will then be proposed legislation. And what is, Pelosi introduced something Monday night. What does that look like? What's going to happen? So we'll talk a little bit about potentially forward looking and what will happen, what you can bank on as a business to respond with. But before getting into it, it's probably worth to frame where we're at and how we got here. So there's been a few key landmark bills that have passed and gotten enacted. And if you remember, the first one was the Families First Coronavirus Response Act. And this was passed before CARES Act. And what happened here was that if families were impacted by COVID or an individual was impacted by COVID, they were actually entitled to mandatorily paid leave, subject to certain limitations and certain calculations. Employers, if you had to be subject to that and pay your employees this mandatory paid leave, you were able to take a payroll tax credit for that to get reimbursed for it effectively. So, worth noting as well, if you haven't heard yet, or if you have, there is a small business exception to this. If you're 50 employees or under, and compliance with this would materially impact your ability to continue as a going concern, you could get an exception from this. But this was like phase 1. Let's first take care of the employees, making sure everyone's okay. The CARES Act came out late March, and included it was 800 pages of legislation, some of which was business related, some was not. But the highlights in here were obviously the stimulus checks came out. This was $1,200 per person, and then a lesser amount per dependent. It introduced the PPP loans, which we'll talk a little bit about, as well as made changes to the existing EIDL loans. So those were already in existence, the EIDL loans, and this just kind of changed the way they work. It also introduced the employee retention credit, which we are going to talk a little bit more in detail about. The employee retention credit kind of doesn't work well with the PPP loan, which is why they're kind of 2 different options for businesses, but introduced that credit. It also did enact and introduce federal unemployment benefits. And this is the $600 a week kicker that expired at the end of July. So, and then the last thing worth summarizing is it also introduced an employer payroll tax deferral. So on payroll tax, the employer portion, you can defer it. It's just a deferral. As of now, you'll have to pay it back, but it also introduced that. And there were some other PPP clarification items and bills that were passed and enacted. But in general, these are the big things that have got us here. What's then happened is sometime in May, the House took up the HEROES Act. And the HEROES Act was kind of this next phase of stimulus money. And it had a very expensive price tag on it, something like $3.5 trillion, which was more than I believe the CARES Act had in it. The HEALS Act, so back to the HEROES Act, the House passed it, Senate kind of just put it on the shelf, just kind of let it sit. So HEALS Act comes through. This is something the Senate proposed, which we're going to talk more about, and they proposed that in August. Similar thing, the House just kind of shelved it. And this is if you've been keeping up, this is the back and forth thing. It's not enough money, it's too much money, and here's where we are. So a lot of our presentation that is forward looking we'll look at the HEROES Act and the HEALS Act, what the Senate wants to do, what the House wants to do. And we'll talk about what Nancy Pelosi introduced that will likely be voted on in the House this week, which is the skinny HEROES Act is what I'm going to call it. But that's where we are now to recap that. So I'm going to talk a little bit about PPP, and this is just updates for everyone. There are thousands and thousands of articles and videos and everything. If you don't have a really solid foundation of PPP, you can get that online, or you can go to Baker Tilly's website. We have a lot of resources. But in general, the time for application is done. So through August 8th was the last day you could apply. So if you haven't gotten a loan yet, unless they change what's going to get the laws are going to get passed, we're here we are, we're done. Now we're going to talk about forgiveness and what it actually looks like. But just as a primer, the PPP calculation to get the loan was, again, 2.5 times average monthly payroll cost with a cap of $10 million. And if you remember, there's almost 3 different tests to get that forgiven. So you got your 60-40 spend. So 60% of your spend of the money has to be on payroll and payroll-related items. Then 40% is non-payroll costs, approved costs, utilities, rent, a couple of other things like that. So that's kind of you got to have your 60-40 split to have it forgiven. And then your other 2 tests are a headcount test. So you can't have a wholesale slash of headcount from a chosen base period. And then there's also a wage reduction test. So you can't have had mass reductions in salaries or hourly rates by more than 25% without having some sort of penalty on the forgiveness as well. So those are just your general tests. What I'll focus on PPP. This is the source of no little frustration to people who've had PPP loans, people who are advising PPP loans, because a lot of these rules are coming out as people are applying, or after they've already applied, or after they've already made some really important strategic decisions on use of PPP loans. These clarification rules and FAQs from the SBA are coming out. So the first was this, and this was probably the biggest one that was like caught a lot of people off guard, was one of the 40% non-payroll costs you can spend your PPP money on was literally just defined as transportation. That is all it said. In the CARES Act, it said this is one of the ways you can do it, transportation. There was no clarification, no definition. I believe in May, in one of the SBA FAQs, they said for a sole proprietor, transportation costs may include things like use of a personal vehicle and reimbursements for deductible mileage. So we run with that, we apply it to a business, and we think we have a good working definition of what transportation is. Sometime in August, the SBA comes out and says, oh, we're ready to define transportation. Meanwhile, the money is generally spent by now, and we had some clients who had actually applied for forgiveness already. And what they defined it as is transportation utility fees assessed by state and local governments, which is not at all what we had thought it would be. So this was a really key change. So if I say this because if you had used the money for transportation type costs and they weren't for these transportation utility fees, which are fees assessed by state and local governments to pay for roads and driveways and all these things, but it's almost like a municipality tax, which are fairly nominal for a lot of businesses, a lot of individuals. So that was a really big change in definition that happened really late in the game. That said, there were some friendly things that they clarified. And one of them is when thinking about what money is eligible for forgiveness, it is cash basis on the front end and accrual on the back end. That's the easiest way to describe it. And what that means is that if you say you got your loan money on May 1st and you happen to also have funded a payroll and paid payroll on May 1st, even though that May 1st check date was for 2 weeks prior, you still get to include that as forgivable payroll expenses. It's the opposite on the back end. Let's say you have a payroll period ending June, but you don't pay that until the first week in July. Well, if your covered period ends in June, you get to include the days worked, even though not paid until after the covered period. So think of it cash basis on the front end, accrual on the back end, and it works the same way for non-payroll costs as well, rent, leases, things like that. The SBA also confirmed there is no accrued interest due on forgiven loan amounts. This was unclear, but they confirmed that if you get it forgiven, the 1% interest on the loan balance for the period you had to loan out until it was forgiven is also forgiven as well. So that was good news. One of the questions that we got up front, and it was unclear, was what sort of interest is includable as forgivable expenses. And interest is one of the 40% costs, if you will, these non-payroll allowable forgiveness costs. What they finally clarified was it is interest on secured debt. So secured by real property, personal property being, tax personal property is what I'll call it. So equipment, vehicles, things like that. Unsecured debt, the interest on unsecured debt is not includable as a forgivable expense, which is a useful clarification. The other thing was we get a lot of questions from clients about, well, I have, for example, I have hourly workers and we reduced hours, but their payroll went down just because I reduced hours. And what the SBA has come out and said that if you just reduce hours, you do not have a wage failure. So a wage test is one of the 3 tests we talked about. If you just reduce hours, but you didn't reduce their hourly rate, you're fine. You don't have a wage test failure to be concerned about, which was useful. Another late wrinkle was a change as well on related party rent. So if you have a borrowing entity and that borrowing entity pays rent to another LLC that owns the building and the land, and that building and land is also owned by one of the owners of the borrowing entity. If there's enough related party ownership relationship there, the SBA calls to see through that rent amount and only allow to the extent that the underlying landlord has interest on its mortgage. That is the only thing it allows interest rent for on related party loans. So it's just something to be aware of, that if you have a related party and you're paying rent to, and you're expecting to have all of that rent included in forgiveness, you need to look through that and see what the underlying interest obligation was and interest debt service was on the underlying LLC, which was a late change. I had a client apply for forgiveness before this came out, and this wasn't in place by then. So, this is kind of where we are in this crazy world. So a great question popped up in the Q&A, and it is absolutely the last point on the slide. So deductions leading to forgiveness are still not deductible. And in walking through clients and what that actually looks like and means, I kind of developed this because I think it does a good job of laying out where we've gone, the steps we've gone through. So in the furthest left column, let's just kind of run through this scenario. You got a loan amount of $1 million. Let's say you get it all forgiven, and we throw a party and got confetti in the air because great, we get free money, even though we had to spend it. So what your P&L may look like down here on the furthest left column, I just have it labeled as book. So let's say you got a $10 million company. We've got cost of goods sold coming out. You got some SG&A coming out. So let's say you have net income before forgiveness. This is just your regular P&L of $1 million. You still had a good year. So then what happens is, for GAAP and book purposes, forgiveness of debt or cancellation of debt is income. So you would have $1 million of book income to get to $2 million of net income after forgiveness for book. Moving one column to the right, what the CARES Act said in writing said the forgiveness of the PPP loans shall not be included as income. So what the CARES Act does is says, great, as of now, it is free money. It's tax-free money. The IRS shortly thereafter came out and said, no. There is a precedent for here in tax law that if you incur expenses to get relief or incur forgiveness of debt in this case, or receive a grant, that even if the grant is not taxable, the deductions are not deductible. So you'll see in my third column, while the income, the forgiveness income isn't taxable, the deductions or the expenses you had to spend and incur are not deductible. So the third column is the IRS getting their shake of it. So we back those out. And what you wind up is your per tax return looks exactly like, at least the bottom line looks like the book income. So yeah, to answer the question, will we owe tax on the PPP if the amount is forgiven? As of now, yes. So for what it's worth, we'll talk about it. The HEROES Act out of the House was going to change that and allow complete forgiveness. The HEALS Act out of the Senate, out of the Republican Party, did not address that. So in all likelihood, if I was doing planning, I would account for it as being taxable. So pause on PPP. That's a quick little update, a quick rundown of what that looks like. What I'm going to talk about now is the ERC, the Employee Retention Credit. What the Employee Retention Credit was because the PPP had limitations on what companies can apply. It's an SBA loan. It's subject to SBA limitations of what companies can get these types of loans from the SBA. So, and there were sizes on it. So 500 employees, and there's affiliation rules applied with the SBA. So if you were part of a PE-owned entity, a lot of times you have to look through that and aggregate all the other port codes to get to your 500 total or go over it. So there were some businesses who couldn't get a benefit out of the PPP because of, a loophole, whatever. They got stuck. But if you were still impacted by it and you still need help, the Employee Retention Credit is one way in which you can seek that help. So we're going to go through what the Employee Retention Credit is. It's gotten much less attention, but it's still worth mentioning that if you couldn't get PPP, you should look at this. And what it is it is a credit, a per employee credit granted to the employer, which will offset the employer share of payroll taxes. So it's a max credit of $500 per employee from March 13th through December of this year. So you have to have qualifying wages. Think W-2, think Medicare, Social Security, Medicare type taxable wages. These are for employees. Healthcare is includable in that. But again, I said it doesn't play well with PPP. So if you got PPP, the first part of the presentation was for you. If you didn't get PPP, you didn't apply, or you couldn't get it, this may be an option for you as well to get some additional funding. So a little bit about the eligibility to get the ERC. You got to be a trade or business. There's a very specific definition in the tax code for what a trade or business looks like. But like, anything you're passive in, think just passive investment company type stuff may not get you there. You should be an ongoing trade or business, a service, or what have you. As well, you need to evidence damage. And this is not something the PPP made you do. The ERC does. So the ERC says, well, you must have a 50% or more decline in gross revenue from Q1 to Q1 this year to Q1 of last year, Q2 this year to Q2 of last year. So you have to evidence this damage. And then there's a time limit on once operations get back up by looking at revenue, and your gross receipts are back up to where they were, or 80% to where they would have been last year, you're no longer eligible for the ERC. So there is evidence of damage needed to be done to get the ERC. Alternatively, you could have a suspension test where you had to be suspended due to government-related orders. So you need to be damaged because of COVID, whereas PPP, not necessarily. You just had to have payroll. You had to have W-2 wages. So there is no size limitation to the ERC, which is what makes it a great alternative to if you couldn't get a PPP. The caveat is there are different rules for under 100 employees or over 100 employees. So under 100 employees, all wages are good. Over 100 employees the rule is you can only use the wages when the employees were not providing services. So for example, if you were paying an employee to stay at home because of suspended operations or furloughed, but you still paid them or whatever it is, you can use those wages for over 100 employees. Just note that there's different rules there if you're under or over 100. But if you're self-employed, you don't get the ERC, but you should have certainly taken advantage of the PPP in those cases. So those are the two key prongs, the PPP and the ERC. I have a slide in here about President Trump's executive order and memoranda he released. Now, this is probably 4 to 6 weeks ago that these came out. I would tell you there were 4 that came out. I'll run through them. The biggest one we're getting questions on right now is the payroll tax deferral. So I'll touch on that. What the first one President Trump laid out, was the federal unemployment benefits that were part of his order, which was, instead of being $600 a week from the Fed, which had expired in July, he offered $400 a week. Kicker, $300 from the Fed and $100 from the states. And the states had the uproar that you think they would, saying you can't make us do this, this will bankrupt us, all of the above. I think it's a non-starter. I think it's just a political move to get some needles moving, something through Congress. So the legitimacy of the order and what it can be done or can it be upheld, yeah, I think it's just a question. But what is in play right now is the payroll tax deferral. So the next order he published and sent out was from now, or I believe it started September 1 through the end of the year, employees under $100,000 who get paid under $100,000 annually, employees are eligible to not have their payroll tax withheld from them, and potentially get it all to them. What we're generally advising is that I think this could get messy because it's just a deferral. As of now, President Trump, the executive branch, does not have the ability to waive taxes like this. That's Congress. So it has to be legislation if you're going to make a tax waiver and forgive the tax on it. So as of now, all he can do is defer it. The IRS can defer it. So Secretary Mnuchin has deferred it. But what's going to happen is if you do this now and you let the employees not have withholdings on their employee side of payroll taxes, and it's about 7.65% of their wages, you give that to them from now through the end of the year. In 2021, you got to pay that back. And that liability is an employer liability. Now, you may have to collect it from the employees, but what happens if they leave or they're gone or they skip town? Well, if you don't have any wages you're paying them to withhold it on, you're still left holding the bag. So because of that, this could get very messy very quickly. Now, it's a very good thing. I think what it's trying to accomplish is very good, putting money back and these people paid under $100,000 pockets. However, I don't think we have enough clarification to advise doing this just yet. But it's certainly something worth having conversations about. The presidential order, executive order, also talked about student loan payment suspension, which he has the rights to do. He can do that. So those are suspended through December of this year. And then also issued an eviction moratorium through December 31. So those are 2 of the smaller ones that he also got through. So those are the executive order. Those are in effect. Authority and precedent on it, I'll leave that up to the experts. So it's worth hitting a pause here, because what we've talked about from here to now is past legislation or things that are in effect. PPP, ERC, as in the presidential memorandum. What I'm going to shift and focus on now is the proposed legislation. And I'm actually going to talk more about the HEALS Act. So again, to reframe it, the HEROES Act was the Democrat bill out of the House in May. Huge spending bill, very big price tag. I do have a slide in here that kind of gives a compare contrast. The HEROES Act, the HEALS Act rather. So the HEROES is the House Democrat. The HEALS Act is Senate Republican, and so it's a smaller act. It's a less expensive act. They will meet in the middle. There will be something passed eventually. Now, open to speculation on when and timing and what we could talk about. But I'm going to focus now on the HEALS Act, the more recent act, because I think this will be a starting point for where we would see things done in the future. The HEALS Act is actually, when it was rolled out, it wasn't just one giant act like you saw the CARES Act or the HEROES Act. The HEALS Act was actually separate, independent bills. And that's why it was really hard to piece it together. If you were hearing this, it was one bill from this senator, and Rubio had his, and McConnell had his, and they all had each their own. When you look at them all together, there's really only probably 4 that probably have a impact on on businesses worth talking about. So we're going to run through the 4 that I have bolded on this slide with what their impact looks like to you, or if passed, what it could look like. So the first was the American Workers, Families, and Employers Assistance Act, and this was probably the most contentious one. Instead of being $600 a week kicker for federal unemployment, this would drop it down immediately to $200 a week federal kicker, and then let people work their way up to be effectively 70% of their previous wages. Right? This is an effort to move the needle to encourage people to get back to work. And not only rely on unemployment, which did happen. We've seen it. We have clients who have been dealing with that for people who have not been returning to work because of unemployment. So this is why this is lower than the $600. This also introduced a second round of stimulus checks, which I think both sides of the aisle are on the same page on. They believe second round of stimulus checks are helpful. Similar amounts as last time is what this act would also do. It would also introduce tax credits for employers who purchase PPE, protective equipment for medical personnel or ongoing, when you can't maintain social distancing, that would give you a tax credit for those purchases. It would also increase the employee retention credit we just talked about. So instead of being limited to 50% of $10,000 in wages, you would get up to 65% of $30,000 in wages. So bad math, but $18,000, $19,000 max instead of $5,000 per employee. So it would increase the amount of credit available under the ERC. The next one is the Safe to Work Act, and I think a lot of these things are very important, but I think if we can talk about one that is probably the elephant in the room, it is this act. What the Safe to Work Act does is creates liability protection based on good faith efforts. So if you have been trying to do your due diligence and doing what you can to protect employees, doing social distancing, following OSHA and health, the HHS mandates, if you've been trying to do that to maintain a safe work environment, this would provide you liability protection for opening up your place of business. We've already seen lawsuits come out, unfortunately, for people who have passed away from COVID, from being required to go back to work. And those are very unfortunate and very sad instances. What this would do is say, well, if you're doing your best, you can't get sued for that. So it's not a blank check to open up, but it is a protection for if you're doing the right thing, you can't get hurt by it. You can't get frivolously sued. And that worth pointing out, that would continue for 5 years up until September 24. So this third one I'm going to talk about, this is, and I mentioned that the HEALS Act and these acts are actually passed by different senators. So the Continuing Small Business Recovery and Paycheck Protection Program Act was actually introduced by Senator Marco Rubio, who has, if you've been following the PPP, he's kind of been the voice of reason in the Senate behind a lot of the PPP and actually calling out a lot of the problems with it. So this is his bill, and it is a very good bill. It is a very good PPP, fixes a lot of issues and introduces a lot of good things. So if you have PPP, this is what the Senate, this is where the Senate's head is at right now. So it would actually, this bill, again, as proposed only, would expand the 40% category. We talked about the 60% payroll costs, 40% non-payroll costs. This would expand that 40% to include things like operation type expenses. If you had to go remote, cloud computing, software, even HR and accounting needs from that. So it expands to include operations. It actually would let you include property damage costs from public disturbances, riots, / protests that we've seen across the country that weren't covered by insurance. Well, you could actually include that as forgivable expenses now. It actually lets you also include almost direct costs, if you will, supplier costs. So if you had a contract in place as of February 15th to buy materials and you have to make good on that, otherwise you're in violation, this would allow you to include those costs as well, be it direct costs or not. And then it would lastly open up and allow for approval of worker protection to be a forgivable expense, which is, again, is PPE, adaptive investments to comply with the CDC, OSHA, HHS, all the other mandates to keep people safe from COVID in a working environment. So those are the places they would expand the 40% category. This next one is from a nerdy PPP forgiveness application standpoint. I love this one because what this does is it takes out all guesswork of what can you use for your covered period. So your covered period is a term that says from the date you got the loan until a date in the future. This is your forgiveness period that you're spending the PPP money on. It first was 8 weeks. You only had 8 weeks to spend it. They came out with now 24 weeks. And so you can use one of the other options, but you can also apply early. And there's just too much question as far as if I apply early, does it mean that I can choose my own date? Do I have to use the date of application that I finally give it to the bank? And it's really hard to interpret that. They have not clarified this. So this would let you choose your own covered date, or covered period, which would be a godsend for me. And it would, we've all heard, or if you're tracking PPP, over $2 million, you're going to get audited. The SBA has guaranteed that you're going to get audited if your loan was over $2 million. If it was under, this act would streamline your application process. So as of now, where we're helping a lot of clients is compiling all the documents that are needed. And these are huge zip files because they're asking for a lot of different things. And what this act would do is say, okay, if you're under a certain threshold, don't worry about that. Make good faith certifications and just give it to us. And if we want to look at it, we'll audit you and we'll look at the support. This would save a lot of time and a lot of money. But until then, we're still, if you got a $10,000 PPP loan, you are providing the same level of information as someone who got a $2 million loan. So this would streamline that. This isn't a rubber stamp by any stretch of the imagination. This isn't a blanket forgiveness. This is just a streamline of the process. It would also introduce, this act, as proposed by Rubio, would also allow for second PPP loans. So there's $130 billion in the first disbursement, the first tranche allocated to PPP, which was actually the second round of funding for it. But this would let people access that, and it actually kicks in more money. But it would change a little bit of the game on the second loans. So it would drop it from 500 to 300 for your max for the second loans. You would have to evidence reduction in revenue and essentially evidence damage because of COVID, which you didn't have to do before. The same calculation, the 2.5 times monthly payroll costs, not to exceed $2 million or $10 million in aggregate with your first loan. Same 60-40 split rules apply for the test that we talked about, and then to spend proceeds by the beginning of next year, January 1, 21. So if this bill was passed, we would have a second round of PPP loans for a lot of damaged and really targeted focused damage businesses. I'm not going to talk too much about this last chunk. This bill also introduces a new type of loan, which would be effectively low-income census tract focused loans. Very, very friendly terms, very cheap credit here, but effectively you need to be you need to have a principal place of business, and your income mostly 50% or more derived from that low census or low income census tract. So it's kind of tied to the PPP loans, very similar to the terms as far as you must show your reduction and damage from COVID, but the loan can be up to 2 times revenue, up to 20 years at 1% with a max of $10 million. So very cheap capital, very long terms on it, but I won't talk about it too much because it's still proposed, and then you still got to be in a low income census tract. So that was Rubio's PPP bill. This next slide is fairly straightforward. The Supporting America's Restaurant Workers Act really just changes your meal deduction from 50 to 100% to support more people supporting restaurants. So here's my compare and contrast slide between the HEROES Act and then the HEALS Act. So this isn't all encompassing, but I think it hits the highlights. So stimulus checks, I think we're both on the same page there. I think both houses of Congress see that as something useful, so it would be there. Unemployment, we see this is the source of contention. So unemployment, the HEROES Act, the House Act would still have your $600 a week through January 21, or if you're self-employed, it would actually extend out longer. And whereas the HEALS Act doesn't go that far. It would drop it down to $200, a max of $500 a week, up to 70% of lost wages. And this is where a lot of the contention is, as I mentioned. The PPP, so the HEROES Act, most of the stuff the HEROES Act had, because it was passed in May, has already been pushed through, with the exception of the deductions allowed. So this is still that third column where the IRS is carving out those deductions. That part didn't get passed here. So you are still going to get taxed on forgiveness in effect. So the HEALS Act would add money to the PPP, allow for second loans, and expand those definitions. The employee tax credit, employee retention tax credit, the HEROES Act expands it, increases it. The HEALS Act does the same thing. The eviction moratorium, the HEALS Act we just talked about, doesn't touch it. The HEROES Act covers it, but Trump has kind of come out and offered something like that in one of his executive orders. Liability protection for businesses opening back up, HEROES Act doesn't touch it, HEALS Act does. This is the 4 or 5 year protection. And then I just put the price tag on it. I think the HEROES Act came in at 3.4 or 5 trillion. The HEALS Act was around 1.5. So that's kind of a quick compare contrast. So I stuck in this slide because this is something that just came out on Monday. Pelosi introduced this idea of this $2.2 trillion bill. So this, I'm calling it the Skinny HEROES Act because it's going to get introduced in the House and will get voted on. I expect it to pass. I think Wes has different opinions than I do as far as likelihood of passing it. I've said things won't pass, and then literally the next day after the presentation, they pass. So who knows? It's a lot of speculation. But I've got a few quick highlights in here for you just to kind of know what it would look like. It would have the stimulus checks in it. It currently would have the $600 a week employment all the way until the end of March 21. This is a long time that they're extending the $600 a week kicker for unemployment. It would extend payroll benefits for airlines, which I know a lot of airlines are shuttering their doors and laying off a lot of workers. I have neighbors who are getting laid off from airlines effective today because of this. So this would extend benefits to the airlines to keep pilots employed. It would extend the PPP loan program and add funding. But as of now, from what I'm reading, I don't believe it allows for second loans. So I don't believe they're going to go as far as Rubio's plan, but they would allow for more people to take loans. It would effectively open up the application window again. So TBD if we get in a second round of loans into this $2.2 trillion bill. I also throw on there, it includes financial aid for schools and childcare centers. It includes financial aids via grants for restaurants, which would be very good things. And then also financial aids for states and cities. And I would offer, if you're going to watch the hot topic issues, what's going to make this thing live or die is really the unemployment and then the financial aid for the states and the cities. That's where it's going to be. How much aid goes to them from the federal budget, and then what are we going to do with unemployment, and what's the right number there? So watch for that. Keep that, we'll see something through the Senate or something through the House, rather, probably this week, I would expect. And then we'll see what gets through the Senate. I think it's a really challenging environment for legislation, is my personal opinion, between you got the Supreme Court nomination, you got the election, which has no lack of contention between the two individuals there, as anyone may have seen on the debate last night. So I think it's just a very challenging time. That said, both sides need to get something passed, so we could see something soon. So another pause. I see one question. I am going to jump into that shortly. But just I want to talk a little bit about what we're doing as Baker Tilly for our clients to help them navigate this. So we can of course help with PPP applications if they open back up. If you didn't get a PPP loan, you would be eligible now and you want to pursue that. We've helped over 250 applications get applied for and funded for our clients. And a lot of it was focused in that first weekend. We've stayed and kind of walked beside our clients over their covered period, these last probably 6 months or so, getting through how to spend the money, what to spend it on, what's eligible forgiveness, what's not. And then also we're helping clients actually apply for forgiveness. So last check, we were at probably 100 or so forgiveness applications we're doing with our clients. So we have a team who's been doing almost nothing but PPP for the last 6 months. So we can tell the ins and the outs pretty quickly. If you have questions, we're here to help. My contact information is in the slides, or you can reach out to me. You can see my name on the screen. It's roger.ledbetter@bakertilly.com, and just kind of talk through how we can help. That's PPP help. We do have a team that's been doing also at a national level a lot of employee retention credit. So we have models and financial models and Excel models that will help you navigate that. What's your maximum amount? When will you hit it? Which could increase, as we saw in the HEROES and the HEALS Act. So, worth mentioning as well is the CARES Act was not just the PPP plan or the EIDL expansion or just the employee retention credit. The CARES Act had just a lot of federal tax implications that opened wide the door to take advantage of a lot of opportunities that were not there before. When the TCJA, which was the Tax Cuts and Jobs Act, this is the tax kind of package that got passed by Trump and Congress December of 17, that we're all now on. This is our regime we're under right now. It left some open holes, some changes in things, and it also had some drafting errors. So for example, if you had a big build out of a building or whatever it is, a real property, if you had a build out of real property and made improvements to it from in 2018, 2019, you had to depreciate that over 39 years because of an error, a drafting error in the code that the Democrats were none too happy to help get technical corrections passed on that, quite frankly, because they had to get passed through Congress. This fixes that. In the CARES Act, it now says, well, you can revisit the money per build out and TI you've spent in 18 and 19, and you can take a huge deduction for that now to help get a refund back in your pocket. It also changes the way you can carry back losses, which for businesses previously wasn't allowed, or anymore. It wasn't allowed for a change for the way for individuals and businesses use those losses. The CARES Act says, hey, for this year, for 20 and previously, you can actually carry those back up to 5 years. So if you have losses, NOLs is what they're called on your tax return, know that there's tremendous opportunity right now to carry those back, potentially get kind of fast-tracked refunds to you. So keep that in mind. There's a lot of other things that happen on the tax side that we can certainly discuss. The last thing I'll throw out there is I'm very proud to have worked on our construction side and the tailoring of this offering. But for almost every industry you can imagine, we have a recovery assessment tool. So how well are you equipped to handle COVID? How well were you equipped to handle COVID and the changes to your environment? And how are you equipped going forward? So just a quick little example of what that looks like, kind of broken into categories. Here's your general scoring. And so what happens is you do the scoring, it generates a report. We can run through the report. You can see your general kind of score, and it lets you know what, or at least pings ideas for what you should be looking at as far as COVID resilience, or not only just looking back, but going forward, how do you adapt now to what will happen? So we have the link in the slides. Check it out. I really hope it's a good tool that a lot of you guys can use just to kind of get a feel for where you're at. So I'll pause, take a breath. I'm gonna take a sip of water. Wes, I see questions here. Anything you want to add or color that you want to throw in there?
Yeah, it looks like some of these here, I don't know if you've looked at these yet, but I've left these first two to you to answer because they are more technical. And then someone asked the question, do you see any issue to code all PPP funds to payroll for forgiveness? I'm not exactly sure what the question is, but I'll answer it this way. When you're going to do your application for forgiveness, I would err on the side of including as much of the payroll in the calculation as you can. So if that's what you're asking, that I would say yes. Don't cut it close on that 60% rule. If you got payroll, do as much on payroll that you can. Leave the extra stuff in case you need to fill in the gap. So because the comment is our staffing company can spend it down in 24 weeks. Yeah, I mean that's what we tell people is use at the end of the day, that was the original intent, and
yep.
Something were to ever get moved around, it'd probably be in that payroll area. So I would use all I could to.
Charlie, Charlie, so I unmuted his mic in case he'd like to clarify if that got answered and what he was asking. But keep going, guys.
Yeah, Charlie, I don't know if that answers your question, but if not, you feel free to speak up. All right, so the other ones there, Roger, are for you.
Hey, this is Charlie. I was muted.
Hey,
So our company, the main account that we took the most for PPP for is basically like a staffing company, and so that's our biggest expense overall, and we have enough to put it towards all the PPP funds for the 24 weeks, and that's what we were trying to do, was err on the side of caution to be forgiven for all of it. That was the question.
Yeah, I think you got to, I heard you say staffing companies. There again, I don't want to get too deep into that, but you just got to pay attention to the head count rules, right, Roger? I mean, the place you trip up with payroll is some of that kind of stuff, but generally speaking, yeah, if you meet all the other tests, yeah, payroll is a great place to be.
Yeah, agreed. So looking at the other questions, so the question is, how do employees who retire during the covered period affect the FTE calculation? Is there a consideration for this reduction due to retirement? So yes, there are considerations, not specifically related to retirement, but related to either a voluntary termination or a voluntary reduction in hours. And I would tell you, someone retiring certainly falls under this voluntary termination. It is certainly not a layoff. This isn't something that you push them out the door. So I would tell you that under my reading of it, that would certainly apply. An important question would be to your banker and just let them know ahead of time, like, hey, by the way, here's what happened. What do you need for this? But we believe that this applies, and we shouldn't get a penalty for that. But agreed that, or confirmed, there should be no penalty for that for retiring. So the next one is, does the Skinny Heroes legislation speak to forgiveness process for a small business under the revenue threshold. Yeah, so I don't believe it does. I don't believe this creates this sort of rubber stamp that a lot of small businesses had hoped for, right? And this is the whole, well, if we were under $150,000 of a loan, you should just get it forgiven without having to submit anything. Yeah, I don't believe it addresses that. So we will see what gets through the House. You know, I think that may increase the cost of the bill, which I don't think is necessarily something the House is going to try to do. That said, you know, who knows what's gonna make it through in the final version of it. So as of now, I wouldn't bank on it. You know, our general advice is that if you can apply for forgiveness now, and you've met all your criteria, you've spent the money, that's probably the right thing to do, which is go ahead and apply for forgiveness. The GAAP accounting treatment, the book treatment, is you're going to carry it on your books as a loan until the SBA tells you otherwise, which is a little bit of a, you know, that's a really condensed way to say that. There are some ways to account for it. But in general, until you get word from the SBA, it's going to carry on your books as a loan. So questions, here's our full contact information. If you have complaints, email Wes. If you have compliments, email me. But here's all, if you have questions, reach out. You know, guys, I can't tell you how much time I've spent either on the phone or answering random emails, just trying to help people. So we want to help businesses recover and get back on the right track. But yeah,
Hey,
other than
Roger,
that,
I've got
last word.
another quick question for you, if you guys have another minute or two.
Yeah.
This is actually coming from me. I sit on the board of a nonprofit, and I'm the treasurer for the nonprofit. Although it is a nonprofit, I do think this is actually really a relevant topic for business owners. So we were a little late to the game, but we just got approval for our EIDL loan. And to my understanding, so we had our PPP, everything should be forgiven in due course. We spent it the correct way into their correct percentages. The EIDL technically would not be forgiven. However, I have read that if you had the EIDL loan first, you can use a PPP loan, or even possibly if there is a second round of stimulus, use that to refinance it, and then in which case it would be forgiven. So it's probably a kind of a tricky question with some caveats, but are there ways around this is around the topic of using PPP or other sources to refinance another stimulus loan? Are there ways to do that in which you can get full forgiveness for both?
Yeah, good question. As of now, unless the second round of loans gets passed, the answer to that is it's not going to get forgiven again. There may be a way to refinance it. If the second round of loan passes, you can demonstrate compliance with needing and being able to get a second round of loans. Yeah, there was a conflict between EIDL and PPP initially, and what came out was clarified was that you cannot use the PPP and the EIDL proceeds for the same thing. So for example, if you got the EIDL on the basis of payroll, it would be really challenging to then say, well, I'm going to use the PPP loan on payroll, but then the EIDL loan was also for that same payroll. What we had advised clients was, what you just did was spend PPP first, then get payroll, because then there's no overlap of paying for the same expenses with these similar two SBA program loans. It's a good question to watch. You know, I'd be willing to bet there's some really good guidance that probably comes out if second round of PPP funding kicks in. But yeah, if you could get refinance with that, there was certainly an option with the first PPP loan, was to refinance an existing EIDL loan.
And what constitutes the same use? Because I even read into this deeper, and it was you could use it for a different payroll period, and then it would be considered a different, it's still used for payroll, but it's within a different period.
Yeah, I would agree with that. You're just not, they don't want you to double dip. They don't want you to get credit for, well, you're using effectively EIDL loan money to get forgiveness expenses paid for by the PPP. Yeah, and this is why we said, guys, close out your PPP, kind of try and shut that door, and then say, okay, this is the end of our covered period, end of August or whatever. Now we've got our EIDL loan, and you can use it for payroll and other expenses that were eligible.
All right. Well, I guess closing remarks is and kind of my last question is, what's your overall opinion of everything, of what's happened, what's been proposed, and maybe what would you change if you could?
Wow. Yeah, I'm probably the wrong person to ask that. I've got different views on giving out free money and rather than encouraging people to work. So I think Congress is doing the best they can. I think there's different agendas at work and people giving out money. That's my take. I would rather encourage these get back to work bonuses and things like that rather than free money. But that's me. Wes, I don't know if you have insight or thoughts there.
Well, I don't want to start a repeat of last night, so maybe we won't go there. It gets very political at the end of the day, and so you know what, it is what it is. At the end of the day, I think everybody just wants closure and direction. So if we could get that, that'd be a win. Even if it's a no, kind of just want to hear no, so we can kind of move on and get these things taken care of. So I think the uncertainty of it all is probably what I would change.
Hey, Wes, you and Roger could both be politicians.
Yes, I try real hard. I am a politician at times, I'm finding. Trust me.
Well, guys, thank you so much
thank
for
you
your
very
time
much.
today, and we really enjoyed having you, and look forward to maybe getting you back on the mic again a little bit down the road.
Absolutely, love to.
We'll get some movement. Yeah.
Yep.
Love it, guys. All right.
All right. Thanks,
Y'all
everybody.
take care.
Good one.
Thanks, guys.
Bye-bye.